Kia ora and welcome to the Reserve Bank's podcast explaining compound interest. Compound interest is a pretty powerful financial concept, but not everyone understands how it works. An easy way to think of compound interest is the interest you earn on interest. Here's an example. Jack and Kitty are thinking about saving for a rainy day. They might save for their first house, head off on an exotic overseas holiday, or put money away for their retirement. Kitty's the organised one. She decides to put $1,000 into a savings account, which will earn 5% interest each year. Look at what happens to Kitty's savings balance. In the first year, Kitty's $1,000 deposit earns $50 in interest. So, by the end of the year, she's got $1,050. Kitty also earns interest in the second year too, but this time she started with $1,050 in the account. So, she earns interest on the full $1,050. That means the initial interest is compounded, and she earns $52.50 in interest in the second year. The benefit of compound interest may not seem very large to start with, but as you'll see, compound interest can make a big difference over time. Kitty continues to leave her money in the account each year, and it continues to earn interest. 40 years later, she'll have more than $7,000 in the savings account, and most of that's been earned through interest on interest. Jack isn't as disciplined as Kitty, and he has his mind on other things. He starts by depositing $1,000 into an account, and just like Kitty, it also earns 5% interest each year. But unlike Kitty, Jack spends the interest he earns each year. 40 years later, Jack's still got $1,000 in his savings account. His initial deposit has earned interest in that time, but unlike Kitty, he hasn't benefited from that interest compounding each year. That's the benefit of compound interest. The longer you save without spending the interest, the more you benefit. And the benefits accelerate the longer you save. Of course, if Jack and Kitty were able to regularly squirrel away more savings into their accounts, an even larger sum of money would benefit from compound interest. And don't forget, compound interest also applies to debt too, and certainly not in a good way. The longer you leave debt without paying interest, the more interest it accumulates, and the bigger the debt burden becomes. So to recap, compound interest is a bit like supercharging your savings, because not only do you earn interest on the money you deposit, but you also earn interest on the interest you earn too. And the longer you save, the more you benefit from compound interest.